So Larry Goldberg is here with our favorite show of the month, where we look at what Cathie Wood had to say about the jobs reports and all other things that have to do with the economy. Larry, the last 2 days of last week, the markets decided, okay, I guess we need a breather here, and they were looking for any excuse, and so we went down a few percent. Did you have any thoughts at the end of the week about? Was this just a little consolidation, a little profit taking, or were people really worried?
No, I think that it's quite clear that we are seeing recessionary forces in the coming to the fore, and we knew that they were coming to the fore. I mean, the employment numbers are the big issue. I mean, they are the principal driving force behind this change. And, we've been calling this a recession for some time.
A rolling recession, however. Yeah.
Pardon?
A rolling recession, as Cathie's called it.
Well, she calls it a rolling recession. I call it a recession.
A recession. Okay.
Look, the Trump tariffs are probably the Trump tariffs and the rampant stock market, and the AI revolution we're definitely seeing the positive results of those. Gary Black had a post yet again talking about Smoot-Hawley. I think he's not, his mind is stuck on Smoot-Hawley, and either he's right and Smoot-Hawley's going to, bring about a global recession, or I'm right and Trump is right, and Besant is right.
Right.
That this is a completely different circumstance as Smoot-Hawley.
Right.
Completely different circumstance. When Smoot-Hawley tariffs went into effect, we were not the odd man out in the world. We were in a world where, free trade was the given. And we didn't raise it by 15%. We raised it by 40, and progressively over a period of time, 40 to 60 to 80 to 100. And so we were buying gigantic, I mean, we were exporting gigantic amount of stuff, and we were importing a fairly significant amount of stuff. So once we raised tariffs, everybody else raised tariffs, and our exports went to hell, and our imports, anyway.
Yeah.
The point is that we were a very different world. And the idea here is not to close our markets. In fact, on the contrary, but it is to level the playing field, which for historical reasons has been against us, has been biased against us very dramatically all across the world, not only with tariffs, but even more importantly, non-tariff barriers. Bottom line is, I think these tariffs are going to work in our favor. I think, as opposed to the historic norm, I think it's going to be the balance in the economy is going to be in our favor, and I think we're beginning to see that. I think the market is reflecting a huge disappointment with the Federal Reserve Bank chairman's remarks and the actions of the Federal Reserve Bank. But remember, for the first time in many decades, there was objection by two governors, not governors, by two Federal Reserve board members.
Presidents or governors. There's some are presidents and some are governors. So it's,
exactly.
Yeah.
But we don't know who were the objectors, We think we know, but anyway. So I think that interest rates really need to be moderated. They are really, really hurting the economy at this point. And you only have to look at the employment numbers. And we've said this month in and month out, these employment numbers are just manufactured.
They're just weird. I did a very deep dive. So I've done at least 2 videos on this already in detail, a couple of rants. So I don't want to go into a lot of detail right now, but I did do a little more in-depth study just a minute ago. So we don't have to do this while we're talking about Cathie. Number one, we got to keep the clarity in our mind that the household survey is probably the accurate one. And it's at 4.2%, which suggests everything's just fine. Then you try to figure out, well, why is it 4.2%? You go back and you listen to Powell. He's not stupid. He may be slow, but he's not stupid. And Powell says, hey, we got less employees, less people to put to work. So obviously, if you got less people to put to work, you're going to have less numbers of people, getting jobs. Well, so I did the analysis with Grok, and it turns out that if you take out the immigration, so you got the immigrations coming in the last 4 years, now you got the immigration going out, or you got out migration.
Immigration.
If you take that into consideration and you put that back into the formula, Trump is actually having about the same number adjusted jobs per month as Biden was in the last 2 years. So it's not up, it's not down, but it's about equal.
Yeah. Well, in any event, the way they count it is crazy. All right, let's look at what Cathie has to say, and then we can comment accordingly.
All right, go for it.
I'm going to share my screen if I can get it to work this time. So I'm traveling.
Yeah.
And so I really haven't had time to actually listen to Cathie at length. I've prepared the slides, tried to summarize her slides in this deck.
Mm-hmm.
So let's see if we can go ahead and share. Tell me when you see the deck.
It is now. There we go.
Is it clear?
It is very clear. Yes.
Okay, so perhaps you can talk to the slides and I can comment.
Oh, okay. All right. This is showing the deficit, the current deficit as a percent of GDP. We were over 7% at one point, 7.3%, and now it has shrunk to being 6.2% of the GDP. So this is good directionally.
That's year to date.
That is year to date. That's in
But we were at 15%, in the middle of the pandemic.
Okay, 15% in the pandemic, 7%.
And in the 2008, 2010 crisis, we were almost 10%. So just, I want to put this into perspective.
Right. And the key thing is that we are headed in the right direction. And the reason that we're headed in the right direction would be primarily the money that's coming in from the tariffs and the cuts to the federal government. So those are the two things that are having impact. And we, of course, saw for the first time since 2017 an actual positive number in terms of revenues versus expenses in the month of June. Not for every month, but for the month of June, comparatively, you have to go back to 2017 to see that happen again.
Correct.
Okay.
Okay,
go ahead.
I think one thing this is proving is that the tariffs have got part of the tariff story is that they actually are going to bring money into the fiscus and reduce our deficit.
Right.
And help in reducing our deficit, which was an unintended consequence. Well, actually, I think Trump had it in mind.
Yeah, oh yeah, definitely. Bessett's been talking about it all along. And of course, the goal is to get to 3%. And that could happen if we continue on this path.
Yeah, yeah. And explain why 3% is more than acceptable.
Well, that's a Besant number, and I think to a certain extent Besant has pulled it, out of thin air. It's kind of like our
No,
2%.
I think it's an intentional number,
Well, no,
Randy.
I'm not saying it's not intentional, but I do mean that I think that I could say, or I might want to say, we should have zero deficit, that we should have a balanced budget. And I
No,
think
I, I
I think
think I think on the contrary, I don't think
oh,
a deficit is bad by
okay,
definition.
okay,
I'll tell you why. As long as the economy is expanding at a rate that exceeds the deficit, we can more than happily have a deficit.
okay.
And the reason that he's targeting a 3% deficit is because that is mildly mildly
Hmm.
expansionary, while not allowing the country's debt to increase.
Right.
And so, a deficit of 3% is more than consistent with where our growth is likely to be. And I think our growth is targeted to be significantly above
Right.
3%,
Right.
which would shrink the total deficit over time. Does that make sense?
Would as a percentage of, I mean, sorry, as would not shrink the deficit.
Yeah. Now, if our expansion is at 5%, then ultimately, even if we have a 3% deficit in the short term, ultimately the deficit will become less and less.
Okay, I think you're saying the debt, no, nothing would become less. So if you've always got a 3% deficit, then you'd
Mhm.
always be, the deficit would be, and the debt would be constantly going up. You would have it, you wouldn't be going up on the percentage of the deficit because you're saying that would remain flat, but you would
Yeah,
still have a deficit every year.
I see what you're saying. Yeah, so the deficit would actually grow because the economy is growing, the
Right,
total.
right.
Um,
A lot of fiscal conservatives would like to see it turn the other way. We'd like to start paying off the debt. That is not in Bessent's plan for the first Trump administration, or for this, if you will, the second Trump administration. In other words, over the next 3.5 years, that's not his plan, but it could happen if there was enough income from a combination of tariffs and taxes, um, and enough cuts in the federal government.
yeah, I don't think the cuts in the federal government would solve the problem unless we reform the healthcare system in the country.
Well, you also always, everybody forgets this, but you have to always take into consideration that as the deficit up, as the interest rates come down, that will also impact the deficit as well. So
Correct.
at
Correct.
some point, you could get at least closer. But 3%, I think everybody be happy, except for fiscal conservatives who would like to see it positive.
Right. Right. I
Okay.
think, I think the 3% will definitely diminish as the economy grows, because
Yep.
as the economy grows, I think the private sector becomes a larger and larger percentage. And I think that ultimately will bring the deficit down.
And that's happening in a major way. All right,
Yeah.
second slide, Larry, here is talking about this, a new one that Cathie hasn't normally put up, which is a comparison of the 2-year Treasury yield versus the 3-month Treasury yield. And she says that when this is negative, it's very restrictive. Now it's heading back into less restrictive territory, but it still is restrictive. And Has been restrictive for 3 years. And that usually precedes a recession. So,
Well, actually, the recession always begins when it turns positive.
oh, is that true for this one as well? I know it is for the 10-year versus the 2-year, but I didn't know what it was for this one.
Yeah, it is true.
Okay.
But what happened in the great expansions, in the very significant expansions, like in the 1890s, it remained pretty negative during that
Mm,
expansion. And the same thing happened in the 50s, in the late
Mhm.
50s and the early 60s.
Mm.
So it'd be interesting.
Well, and you point out here at the very last point that the odds of a Fed cut of 25 basis
Fine.
points has gone up to
Yeah.
88% in the poly market, and maybe a 50% cut. That's now at 25% in the poly market.
It may have even climbed since I made the slide. I haven't checked late today, but
Well,
I
there's
think
also this change. There's also this change of the one of the governors has quit,
yep,
and Trump will be able to put somebody in her position. Now, she
correct.
was already going to be out, I think, in January or February, but this will give us an earlier additional vote, probably. And maybe if the vote is three individuals who are fighting the rest, maybe they'll have a better chance of changing some minds.
Yeah.
The labor market indicators. So this is her rolling recession idea that she's been talking about forever, and which we've agreed on. Both of us had agreed that there's been some parts of the economy, the over 100,000 people making over $100,000 a year were never in recession. The people under 100,000 were. And then multiple parts of the economy, like transportation, manufacturing, et cetera, were in recession, whereas government, healthcare, education were not ever in recession, and services in general were not in recession. So we have this extreme downward revision to the previous month's employment data, 150,000 change. And of course, since then, what we know is that the president has fired the data creator, or the lady in front who's in charge of getting this data. She'll show us a chart in a minute. Let's not get into that right now, because she's going to show a better chart later that talks about the reasons for her being fired. Cathie also brings up a very interesting thing about the birth-death ratio assumption, and that there are more companies being, I'm not sure I got this right, Larry. Maybe you can help me on this one. This is the difference between the number of companies being started who have added employees versus the number of companies that have died who have shed employees as a result of the death. The average is 100,000. And this is an assumption right now of 257,000, and you've got it in red. So does that mean that there are more people losing their jobs?
Yep.
Okay. All right.
So I mean, the question is whether or not the assumptions have been so badly wrong that they've had to make this adjustment, or whether they're making this very large assumption now because of the tariffs. You know, the problem is that so much assumption goes into these numbers that the question is, what are the assumptions being made, and are they being made for political purposes?
Right. And then the last number here, which is the blue line, is jobs easy to get minus jobs hard to get. I like this index a lot, and to the extent that it has any value, it is indicating that it's gotten quite a bit harder to get jobs. We're seeing that on tons of data. We're seeing that on the Thursday unemployment numbers. We're seeing it in some of the S&P services and manufacturing indices. So this is kind of an understanding right now, is it has gotten much harder to get a job. That seems to be clear.
Yeah, for people all up and down the spectrum.
Right.
So, you know, definitely we're seeing some significant problems. But of course, the interesting part for me is the federal government reduction.
Right.
And here we're seeing the Doge
Okay.
suspensions finally coming through after all these court cases, and after the actual rescission bill passed the House. And so I think that people are just leaving of their own volition now.
Yeah, and so your point is that we got 84,000 already that are definitely gone, but
Yeah.
another 150,000 that would be expected to be off the rolls over the next 2 months.
Yeah.
And that's going to impact the numbers. It's going to impact the numbers. And only found one article, Larry, this week that spoke to this, and that was a USA Today article who mentioned both the immigration problem and the federal government jobs. These are the two things that are impacting the jobs numbers more than any other, and nobody's talking about them. Except
and the birth death ratios well, and we just don't know, how many, how many were not recorded in the past. So this is really exposing just how bad these numbers are. And we've spoke, I think every month we speak about, how not unreliable or how unknowable these numbers really are, because we've had major drastic revisions in the past showing us that these numbers are just not something we can rely upon.
100%.
So this is very important. This is the tax bill that has just passed. And this slide is actually taken directly from Cathie's slide. All these other slides are kind of summaries of a group of slides, but this is taken directly from Cathie's slide, where she's showing the impact, showing the changes in the tax. And so what we're seeing is that, if you look at manufactured structures, that is to say the buildings that people put their equipment into, the factories, buildings themselves, in the old world, the old depreciation schedule, we were given, let me just get a pen here, see if I can get a pen here. Yes, I think I can get a pen here.
I see it. I see the pen. Yeah, there it is.
Good. In the old world, we were allowed to do a straight line, and we were allowed to depreciate that stuff over 39 years. So if you spent, like Elon did, a couple of $1 billion building a factory, you get to write that factory off over 40 years, 39 years.
Right.
But now, starting in 2025, you could, all the way to 2028, you can depreciate 100%, $5 million off your revenue or off your income, directly off your income. And that will eliminate tax on that $5 billion of profits.
Right, right.
And that takes you through from 2025 to 2028. So that's a huge deduction. I mean, I think we had this back, in the, I think it was in the early Nixon years. We tried to do that to spur investment in the economy.
Yeah.
But that's back again, and that's going to be a big number. That's going to have really big impact. So then we have equipment. In the old depreciation days, we could depreciate 60%. Now we can depreciate 100%.
Right.
So all the equipment we put into the factory to build the cars, whether it's $1 billion or $1.5 billion in the past, we could take 60% of that money and depreciate it. Today, we can take 100%. And so that's 40% of that, say it's $2 billion, $800,000 we're going to save tax on. That's another $800 million. That's another $320 million. And domestic R&D and fully expense it. In the old days, we had to amortize it over 5 years.
Right.
Now, Elon's company has always fully expensed their domestic R&D, but then they have to add it back for tax purposes.
Yeah.
Now they're going to be able to expense it and reduce the tax on it. And software, again, 100% depreciation versus what we used to do at 60%. And by the way, these changes here are permanent.
Right.
Man, this is, we're going to see a huge amount of capital suddenly being deployed.
Yeah. And so, Cathie points out that this results in an effective tax rate on average of 12 to 14%. And she compares it to Ireland. And maybe people remember, I know because I'm 25% Irish, Larry, that I was paying attention a few years ago when Ireland dropped their corporate tax rate down to the same level. And the result was everybody and their third cousin incorporated in Ireland. Apple famously ended up with massive amounts of tax savings and ended up with a big Euro fight over this whole thing. But yeah, lots and lots of companies reincorporated in Ireland, and the result was Ireland went from being almost a third world country in the West to being the highest per capita income country, I think, in Europe.
Yeah, and EU try to destroy them.
Yeah.
You find them the difference between the tax they had collected and the tax rates that apply in Europe, and force them to raise their tax rates. They settled, but nonetheless, just gives you an idea. I mean,
Yep.
is Europe going to try and sue us?
Yeah, maybe.
Wouldn't that be fun? Okay. Oh, look what happened.
What happened? Oh, I don't know. You were making some notes, huh?
Did my pen stay on the screen?
Your pen. No, you lost your pen.
Yeah. Did
Cursor, not a pen.
did the marks go away, or do they?
The red marks, the red little
Yeah.
boxes and stuff. No, they're there.
Are they there still?
Yeah, yeah.
I wonder how I get, I can't really work without without the split screen. So I've got to find
yeah, your split screen problem. Yeah.
I don't know how to get rid of them actually. Let me see.
Well, while you experiment, Larry, I'll start talking. So we've got productivity, of course, is one of my hobby horses. I talk about it all the time. If you've got great productivity, you're going to have less inflation. The more productivity, the less inflation, and also it's going to have a huge impact on GDP and on wealth of the entire community. So productivity right now, she's thinking it might go as high as 5% or higher in the coming years. Right now, it's still at kind of the average that we've seen over the last 30 or 40 years, around 1.5%, 2%. But she thinks it will dramatically increase, primarily because of AI and robotics.
So right now it's at this 3% mark. She's looking forward to it going up within 2 years to the 5% mark. And she may, I saw it happen in 2008, 2009. So, I mean, she could be, actually, it happened earlier than that.
It happened in the 1990s also, yes.
1999, actually, 1999, yeah, in the 90s during the Clinton administration. They enjoyed.
I think this will be more sustained because she talks about the confluence. So
Yeah.
you've got AI coming in at the same time. You've got breakthroughs in other worlds, and then you've got robotics coming in at the same time. So all of these things are going to be impacting one another to where it's going to, as she likes to talk about, it's going to impact medical, it's going to impact accounting, it's going to, I mean, it's just so many different fields.
Industry,
right?
It's going to, healthcare, there almost is nowhere that it doesn't impact.
Right.
All right. So, I mean, here's hoping, right?
Yes, that's right.
Yeah. So, trade impact drama. So, if we start exporting and we reduce our imports, that contributes to the GDP, right?
Yep.
So that's what she's looking at in terms of the tariff impact on GDP growth. And in a way, that's been, we've exported a lot of services, but we've imported a huge amount of manufactured goods.
Right.
So that's really the big issue in terms of, what's going to happen in terms of trade and whether that's going to reverse and add significant growth to our GDP.
So, Larry, somebody made a great comment the other day. I really loved it. They said, what we've done in the last 6 months is we've ended the Marshall Plan. So everybody
That's a
knows.
great remark. Yeah.
So you got the Marshall Plan that helped Europe and helped Japan and after Second World War, and all these countries just flourished as a result of the United States helping with the Marshall Plan. But we forgot to stop it. And then we took the Marshall Plan and we said, okay, China, you get some Marshall Plan too, and India and Indonesia and the Philippines. We're just going to give everybody the Marshall Plan. And all these countries have done well under the United States' largesse. But Trump felt it was now time to say, enough. You guys.
Yeah, you forgot Mexico.
Yeah.
You know,
Yeah.
we delivered the Marshall Plan to China and then to Mexico. And, you know, I mean, we were even delivering it to Venezuela.
Even Venezuela.
You know? I love that. I wonder who said that. Was it Sebastian?
I can't remember who it wasn't CERN. It was on X, and I didn't write down who said it.
Somebody deserves to get it. All right, so sorry. Yeah. Now let's talk US real estate prices, Randy.
Yeah, how about that, huh? So what we got is, Nicholas Gibbs started talking about this about 5 months ago. Larry, you're right in the heart of it right now. He started seeing the prices dropping in Florida. I said, it's only Florida. But now it's the entire US except for the Northeast.
Yeah, our prices. So I'm selling my house because we're moving in, I guess, October, September, late September. And we'll put our house on the market in September. I'm hoping that this situation turns around. But our neighbor, actually, she put her house on the market. She's moved and she's put her house on the market. And she had to put it down, you know, she had to mark it down by a good 5%, 4% on where she was just 3 months, 4 months ago.
Right. Yeah. Well, it's definitely in California too. I've mentioned on this channel that my neighbor, who's a real estate guy, I talked to him the other day, and you know, we never had any homes for sale in this neighborhood, and now there's 4 and 2 that have been taken off the market because they weren't moving. So it's a big difference between this year and last year.
But look where we are. We're where we were in 2008, almost where we were when the crash happened in 2008. So the question is, do we recover from this? Do we go down further? You know, it's very worrying, and a lot has to do with the mortgage rate, and the mortgage rate a lot has to do with, you know, where we are in terms of total liquidity in the market.
Well, the 10-year is the decider. The other thing is you got to watch out for these real estate analyses like this. So a lot of times they're talking about the median price or the median price. They're looking at how much it's increased year over year and stuff like that. The truth is that most of these are the decrease or increase year over year is interesting, but by comparing it to previous periods, all you're looking at is the increase or decrease. You're not really looking at the fact that it has already increased by a dramatic amount. So obviously, if you get to the end of your skis, it's harder to get up another 3% or 5% or 6%. So
yeah,
we have to be really careful how we analyze.
These aren't prices, these are percentages.
Yes, exactly.
All right, so this slide didn't turn out that well.
Oh, okay.
Didn't have too much time to make these slides, so I just had to go with what I ended up with. So I'm sorry about it.
Yeah.
So you can't actually see the trend from, you know, core PCE to trueflation to real PCE.
Okay.
I should have expanded, you know, the scale, particularly in the 2025 period.
Yeah.
But you can explain about the difference between trueflation and where we are with the PCI.
So this is another one of these areas where the Bureau of Labor Statistics, the lady who was just fired, hopefully maybe the new person will come in and show some leadership and bring us into the 21st century, because this is ridiculous that we've got the rents have been flattened down now for over a year, You've got housing prices now starting to come down, been coming down for a couple of months, but we won't see that for months and months in the CPI numbers. Well, that's not very helpful if you're trying to make some plans. So Truflation is already showing these things. And so Truflation right now is sitting at just over 2%, 2.01 last time I checked, on the overnights rather, and 2.1 on the year over year is where
we'd have to expand very much larger the scale. That's where I went wrong.
Yeah.
And I didn't have time being on the road to redo the slide. But
Right.
if you look at 2025 here, there's actually a very significant difference between the core PCE, the Truflation, and the real PCE ex healthcare.
Right.
There's actually quite a big difference, but the scale is so large that you can't see the difference here.
Yeah, and I dig in, Larry, you may know this. I dig into the details of
Yeah.
Truflation and the details of CPI. And the truth is there is we're seeing a slight bit of hit, maybe from tariffs on things like furniture.
Yeah.
But that's really the only place we're seeing any hit. And the rest, everything else across the board is pretty much down. And when I say down, I don't mean deflating, but disinflating.
Yeah. Yeah. Okay. Now the 10-year Treasury.
So we're sitting at 4.5. 4.25 to 4.5, of course, which is the number which everybody wishes they had reduced. We're sitting with the actual 10-year at 4.3, 4.35. So right kind of in between 4.25 and 4.5, which is their range. So on the one hand, one might say, oh, wow, they're really close. So maybe it's the right number. On the other hand, we've seen the chart before, Larry, we put it on here in prior months where the Fed and the 10-year can be widely divergent. Sometimes they're going in opposite directions, which they just did. So that's not necessarily a tell.
But if you look back and you see, how bad things were just as Reagan took over, when we had those four very, very poor presidents. We had Johnson, Nixon, Ford, and Carter.
Yep.
And they left us in this terrible situation. And then had this great moderation from Reagan on down through Clinton and so on. But we're going to see a period now where I don't think we're going to get back down anywhere near that level again. Because if we are going to see the kind of growth that we're talking about, then I think we're going to have to get used to rates that are higher than the 2.5 or the period, the kinds of levels that they were at the end of the Great Moderation.
Here's the thing that I also don't hear anybody talking about, Larry. I mean, nobody, not even Cathie. There are so many changes right now, big changes by Trump. These changes are unprecedented. He's changing world trade.
Secular change.
He is changing the way that we do our taxes. He is changing the way that we're going to be impacting the manufacturing base of the United States. He's getting all this new money coming in from all these countries in order to start projects in the United States. There is immigration stopping, out-migration now, or emigration, as you say. So all of these changes is kind of like trying to guess the weather. When I was growing up in St. Louis, people say, well, if you don't like it, wait an hour. I mean, it's hard to know how and productivity through AI and robotics, all of these things are happening at the same time. And being able to figure out how all of this will play out a year from now, my best guess is lots of productivity, lower interest rates, all good.
Well, Scott Besson seems to indicate that. So time will tell.
Yep.
I just think that we may have to live through a period with, interest rates around the 4%, 3.5%, 4% mark.
That'd be, yeah. I think that'd be
Because-
fine, Larry. I actually think it'd be good.
Yep, yep, yep. And then market resilience figures. You want to talk to that?
Sure. So what we do here is we're looking at the S&P 500 to gold ratio. And so the issue is gold, which is kind of a haven, doing better, or is the S&P, which is more of a risk situation, is S&P doing better? Well, gold has been doing very, very well. And the ratio is moving upward. Gold is in the ascent. Well, wait a minute. Is this, I might get it backwards here, Larry, so I gotta be careful.
Gold is definitely in the ascent.
Gold is in the ascent, even though S&P is doing well, but
Yeah.
gold is apparently outracing it. So that would mean that there is at least some risk off, I guess. But in general, it's kind of hard to say that there's risk off when we're seeing what's happening with the S&P at 22 PE. So, so I'm not sure that we're getting a clear idea here.
No, we're not. I think the risk on, Cathie says the risk on will accelerate when recession fears clear. So she thinks we're going to go back down to these
Got it.
levels again.
Got it. Okay. And of course, Bitcoin, we've also seen that. Of course, Bitcoin is, as CERN Basher will tell you every Thursday on my show, Bitcoin is going crazy. The fact that I didn't invest in any Bitcoin when, 15 years ago is on me, but oh well. You can't win them all. But
Yeah, so the Bitcoin Meister is arriving in Florida tomorrow.
mm,
My nephew
yes.
famously bet on Bitcoin, I don't know, 16, 18 years ago. And, he's done incredibly well.
Yeah.
Yeah.
So we'll see how Bitcoin continues. Again, it seems to be risk on. Some people think it's a haven, but it seems to be acting more like a risk on asset at this point.
It certainly does, doesn't it?
Yep.
And yeah. So on balance, I would say that the true the true economic situation is masked for us because we have very poor data. And so it's kind of like mystery meat, we just don't know what it's composed of.
Yeah, the data that we do have that's good though, market data is exact. So when we look at the price of the S&P and the PE ratio, et cetera, that's exact. And so I do worry that 22 is stretched. I'm now my new question, Larry, is can the S&P go beyond that stretched level if the GDP is racing ahead at 5 or 6%? So
If the GDP is really racing ahead at 5, 6%, if Cathie is right,
mhm.
if we're undergirding the economy with massive improvements in productivity, then yeah, I think it can be maintained and it can even go up from here.
Right,
I
right,
mean, we look at Tesla and we are predicting very high levels of stock price for Tesla.
right.
But I mean, you could be looking at Microsoft, you could be looking at Nvidia, you could be looking at Amazon, you could be looking any of those companies and a whole bunch of startups which we're not even looking at yet, private companies. I mean, I'm invested in a bunch of private companies that I feel very good about over the next 5 years.
Yeah, no, it's and again, it's uh the PE ratio is obviously related to risk on and also
No
related
doubt.
to future earnings. So
Yeah.
if future earnings look like they're going to be going up every year 20%, like they have the last, or 9% or 12% or 15%, then higher PE may be justified. But right now, I'm still thinking that we're probably going to have a little correction here.
But Randy, I'm invested in a bunch of small infrastructure companies.
Uh-huh.
on the, in the mid caps,
Yeah,
actually, yeah, mid to small caps.
yeah,
And I invested in them, at the beginning of the year when Trump came in, and they're not high tech companies.
yeah.
And I'm up like 40-50% on those companies.
Yeah, well, there's no doubt that the infrastructure, especially depending on what you're invested in, the infrastructure is going to be getting some
Yeah,
money.
but that play didn't work for Obama, and he put a whole lot of money into infrastructure. And that play didn't work for Biden, and he put a bunch of money, into what he said was infrastructure. Do you remember shovel ready?
But that's government infrastructure, and we need it. We need bridges, we need highways, but you're putting your money into infrastructure that's going to benefit the private sector.
Yeah, but you'd think that if they're going to do bridges and roads, that they would spend with infrastructure companies. The trouble is that money never got spent. All that money got frittered away, in consultants who were consulted by consultants.
Right? Yeah.
But 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 actually, I'm up better. I've done better with those investments than even with my Nvidia and my Tesla stock.
Wow. Well, yeah. Not all together on your Tesla stock.
No, since the beginning of the year,
Yeah, okay.
since
Since
the beginning, since I invested in
yes,
those small
yeah,
companies at the beginning of the year,
yeah.
I'm up very significantly with them,
Mhm, mhm.
which means that the bricks and mortar, the small industries that cater to building factories are really doing well, or their futures look that good
Right.
from their order books. Their order books are very solid. So anyway, just for what it's worth.
For what it's worth, I agree with you 100%. In fact, it's pretty funny because I'm working on the chapter right now in our book. By the way, if you don't know it, Larry is one of the contributors to our book on AI.
I
I
finished
happen,
my first draft.
and you finished the first draft. Well, I finished the first eighth of the first chapter. Then
I'm sending you my first draft tomorrow. It's kind
oh,
of, I think it needs a lot of rework, but it's got the thesis in it.
okay.
I love the chapter that I've got, and I love because it really it's the center of my thesis.
Okay, cool.
I
And
can tell you the thesis if I'm allowed to give away the secret here on
go ahead. Absolutely. Yeah, we want people to get excited about the book.
I'm supposed to write on inference.
Right.
And I say, okay, the battle for training is over. The battle for inference is about to begin.
Right. Okay. That's the theme.
That's the theme of the chapter.
And who could argue with you because Jensen Wang says that's true. Therefore,
After I said it.
okay. Oh, well, that's of course. Of course. It's always here first. It's always on this channel first. Everybody
Well, we
knows.
spoke about it, I think, a week or two ago.
Well, Larry, the other thing is the chapter I'm working on right now is on all the aspects of mining, extraction, all the things that are going to be
Data mining, you're talking about.
not data mining, no, the actual mining, physical mining, infrastructure, et cetera, in order to make the
Oh,
battery,
I
the
see.
energy,
Mining of the energy,
chips, the
the
chips, the
energy
yeah,
sources.
that's what I'm working on right now is all. So the very thing you were talking about, that U.S. American infrastructure that we need in order to
Ah,
get the rare earths, in order to get the things that we need to make these things. Yeah.
yeah, but my investments in infrastructure. Now, interesting enough, I did have a rare earth investment back years ago when Chamath did the pipe for the float for uh, putting this mining company, rare earth mining company, U.S. rare earth mining company on the market. This was around about 2020, 2021. And I was following all Chamath's deals. Anyway, yeah, the rare earth thing is good, is important, but I'm just investing in like brick and mortar kind of companies that build factories, companies that equip factories, companies that do all the infrastructure that you need if you're going to build a factory.
Right, right. Yeah. It is exciting times, and this book is going to be amazing. So, be aware that it's coming out. We're shooting for the end of September. So save your $4.99 for the end of September when we come out with the book.
What happens if you want an opener instead?
If they went what?
If they want an opener, then
A
they're
bottle
going to spend
opener
the
instead?
$4.99 on the opener.
Well, no, the bottle openers. Is that what it was? $4.99. Yeah, that's what it is, right? No, it's more than that. No, the bottle openers are $20, Larry.
So now they could have bought 5 books and they're buying a bottle opener.
No, 5 books instead of 1 bottle opener. I mean, it sounds like a terrible deal to me to get the bottle opener. Okay,
Right, Randy.
Larry, as always, my favorite time of the month to go through the Cathie Wood thing with you, and I hope everybody else enjoyed it as well. And Larry, enjoy your time in Florida, and we will see you. Will we see you on Monday?
Yes, there's a good chance I'll see you on
good chance.
Monday. I can't guarantee it, but I'll try and make it happen.
All right. Okay. Thanks as always, Larry, and to all of you out there. It's been great talking to you.